All right. Well, it's 5:32 p.m. here in the West Coast. So let's get started. Thank you for being on time to today's webinar here at QX Financial. The title for today is Life Armor, Unpacking the Power of Insurance Protection. So today we're going to be focusing on life insurance, its capabilities, what it is, what it's not, what it can and cannot do. So I'm going to try to give you a big picture breakdown of what life insurance is all about and how does it fit within the context of financial planning. Okay, there are a lot of misconceptions, a lot of myths about insurance, and so I like to address those today to the best of my abilities. A couple of housekeeping issues before we get going. If you're using the Zoom client, the Zoom program, you should have a Q&A button or box in your phone or computer. If you have any questions, feel free to jump in and put questions there. I'll be looking at the questions box as I'm going through it. So, or the chat feature, I should say. Uh, so there's no interruptions of any kind. There's no problem if you putting a question there. As soon as I see it and I can address it, I will do my best to do so. Okay, so if you have any questions right away, do me a favor, put a question in there. My partner, my business partner, Sharadi, will be doing the moderation there and letting me know if there are any questions. So once again, feel free to put any information or any questions that you may want to discuss with us today. Okay? All right, perfect. So let's get going. So let's start with the basics. First and foremost, what is life insurance? Life insurance, like just like any other financial instrument, is a risk management tool. We tend to think of insurance as money that goes to somebody, something happens to me, or a version of that. And yes, there's some of that, but really, I would like you to think of it as a risk management tool, as a financial instrument designed to protect us of a certain kind of risk. That's what it's all about. So, what is the risk that we're trying to protect against? Well, the risk is your inability due to death or sickness or disability to maximize your economic potential. This is a very important word that I'm going to be using throughout the presentation, your human value or economic potential. We know from a moral perspective that the human life is invaluable, right? There's no amount of money that can replace human life, obviously. However, in this world that we live today, in this capitalist economy, we gotta figure out, we gotta put a number on how can we value somebody's economic contribution to the overall economy. And that's where life insurance comes in. So it is designed to replace or complete to somebody's family when the person passes away that economic output that they were unable to create because of early passing, disability, or sickness. That is the whole point of life insurance. Life insurance has been around for a long, long time. I don't mean to bore you with the whole story, but it's been around for over 400 years, and it has been proven over and over to be one of the most, if not the most stable financial instrument in the whole universe of financial services. Over 400 years in the marketplace, especially in Western Europe. As a matter of fact, you can still find companies in Western Europe that were founded 350 years ago still doing business. Here in North America, you have companies as old as 150, 160 years old, still actively selling policies and paying benefits. So that is the power of life insurance, and that's what it is. It's a risk management tool. So one of the questions that I always get from clients is, how is it possible that life insurance is so stable and is so guaranteed and it can be around for such a long time? And the secret sauce, if I can call it that, of the life insurance industry is something we call actuarial science. Meaning we're using the law of large numbers, we're using longevity, life expectancy as the instruments that run our products. So it's not about market performance, it's not about interest rates only, it's not about economic cycles necessarily. There are many, many situations where you have major wars, major economic dislocations, and the life insurance industry is still there, paying benefits and chugging along, right? Because The pricing, the value of those products are not based on any of those factors like some stock market products are. It's completely based on actual science, human life expectancy, and the law of large numbers. In other words, we have a huge pool of risk that protects the premium payers and the benefit receivers. I like to say this in a different way. I like to tell people that from my point of view, life insurance is the most socially responsible product in the universe of financial services. Why is a financially responsible or socially responsible product? Because really what's going on is all of us are paying premiums into a pool of risk for the benefit of the widow, for the benefit of the children, for the benefit of another family. Unfortunately, sometimes we as customers or clients, we fail to see that connection because there is a huge intermediary in between, which is the insurance company, right? It's a huge institution managing billions and billions of dollars. And we fail to see that really you have people paying money into a pool of risk for the benefit, direct benefit of other people. That's really what it is. So I would like you to think of the product in that way as I'm going through the presentation. But from our perspective, that's what life insurance is all about. Okay, so with that being said, let's talk about the different types of life insurance. Life insurance is not always, has always been the same, right? So I like you to think of this graph as the human life expectancy here in the bottom, right? And then here at the top, we're going to have premiums, right? So when an actuary looks at life expectancy, looks at the census tables, and is trying to figure out how to price life insurance protection, they're looking at a curve like this. This is not perfect to scale, obviously. My drawing skills are not that great, but you get the idea. The younger you are, the less expensive it is to protect you. The older you are, the more expensive it is to protect you. Why? Because you have a shorter life expectancy. Once again, life insurance runs on life expectancy and the law of large numbers. So we're going to talk about some of the major myths and misconceptions about life insurance in a little bit. I have a slideshow to show you after these drawings. And one of the things that people think about is like, well, it should be very expensive, right? If I buy $1 million, $2 million of protections, it should be really expensive. And when you actually run the numbers, you realize it's not. And the reason why it's not is because if a young person buys a lot of protection, they have such a long life expectancy and the odds of them dying very soon are so small that we can afford to charge a very small cost for a large amount of protection. As you get older, the opposite is true, right? The closer you get to your life expectancy, the more expensive it becomes to provide that protection. And that's what these lines represent. So historically, when we talk about life insurance, we always talk about 1 year renewable term, right? So every year that you had that protection, your premium went up. This is the old school traditional life insurance products of the 19th century and early 20th century. Nobody buys that anymore, by the way, but this is just to help you understand how life insurance works. Obviously, because people didn't want to see their premiums go up every single year and eventually not being able to afford them and lose that coverage, the insurance company came up with the idea of something we call whole life. And because we have a great marketing department at the insurance industry, whole life refers to having life insurance for your whole life, right? That's what it means. And instead of changing your premium every single year, you will have a level premium all through your life, guaranteeing that if you pay your premium, you will receive the benefit. And as you can see, in the younger years, it will be a little higher than regular term insurance, right? But it will be significantly cheaper for you in the older years. In other words, take the two ends of the first curve that I draw and then flatten that curve, and what you get is whole life. Instead of having an increasing premium over time, you have a level premium over time. So we can classify most life insurance products in two camps: temporary insurance and permanent insurance. So we just talk about whole life. So whole life is a permanent product. It's designed to provide coverage for all of your life. Now, there might be reasons why you may or may not need to have whole life for the rest of your life. We're going to talk about those in a moment. But the point is that the product exists and has the ability to provide protection guarantee until the day you die. Term insurance doesn't work that way. Term, as it says, provides temporary protection. And in today's world, you can buy 10, 15, 20, 25, and up to 30 years, depending on your age, of temporary protection. So what does that mean? That means that if you buy, for example, 20-year term, after 20 years, your premiums will go up or the coverage will go away. You're just buying something for a specific amount of time. So why will people do this? Well, because you may have needs that are not permanent, that are only temporary. Let's say, for example, you get a mortgage, right? You got a 30-year fixed mortgage, and you want to protect the value of that mortgage. So in case you die, the mortgage is paid off, as an example. All right, so in that sense, it makes sense to buy a 30-year term for the value of that mortgage, and then you're going to have a level premium, a fixed premium for those 30 years. If you never die, the insurance company never pay any money. If you survive the 30 years, then insurance goes away, but also your liability goes away. Think about parents that have young kids and they only want coverage until they go to college or until they become financially independent, right? So those are temporary needs. On the other hand, you have permanent needs where whole life, and also we have another product called universal life in different variations that can offer permanent protection. Whole life and universal life, they're not the same. So today's presentation is not designed to give you all the ins and outs of whole life and universal life. We are here to serve you and work with you individually if you want to learn more about the difference of these products. But for today, it suffices for you to know that both are permanent. Whole life provides guarantees. Universal life provides no to very little guarantees. That is the difference in the big picture. So why will anybody need permanent insurance? Why will anybody want whole life or insurance, life insurance for all their lives? Well, think about estate planning issues. Think about business succession issues. Think about families that have children at a much older age. So term insurance is not affordable. It doesn't make sense for them to do it at that point in time. Think about families that still have a mortgage after they retire. There are a lot of financial commentators out there that say, no, 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 you should buy term and invest the difference. You should never have insurance after you retire. It's a waste of money. And the reason why they say that is because they live in a world, as I like to describe it, that is fantasy land, right? In their world, you go to college at the age of 18, you marry your high school sweetheart after college, you guys have 2, 3 kids, have a perfect life, no sickness, no unemployment, no problems in between. Kids graduate, they go to college, they're financially successful, your mortgage is paid off, and you can ride into the sunset. That is the story that most financial books and financial people talk about. But I think you and I will agree that that's not the real world. In the real world, people get sick. In the real world, we have children with autism, with Down syndrome. In the real world, we divorce. Children die before they get to maturity. They're not financially successful. We cannot afford to pay the mortgage within 30 years. That is real life. So having insurance beyond the traditional story that we're told is a way to protect against those eventualities. And some of those things will happen. We're going to lose our jobs. The economy is going to change. We know that the economy is cyclical, right? So we're going to go through lots of changes. So having a fixed story that we have to, or a fixed script that we have to follow, it becomes a very difficult way to live. However, if you have a financial plan, life insurance being part of it, that can provide you with flexibility and the opportunity to respond to those life events and life changes, you are in a much better position to be successful financially and to protect your family and to protect your assets. I hope that makes sense. Let me see. You guys, no questions yet. Again, if you guys have any questions, so far, feel free to use the chat feature on the webinar. Just drinking some water. All right. So moving on. So those are the types of life insurance. So now the question becomes, how much? How much life insurance should I have? And also, what kind? And if you need both, what are the ratios? That's a very intelligent question, fair question to ask to your financial planner. Obviously, every case is different. I cannot give you one answer that's going to fit everybody. We all have different ages, different liabilities, different financial situations. What I would recommend is reach out to us or reach out to your financial professional, ask them that question. And hopefully that what they will do for you is what we call a life insurance needs analysis. It's an actual analysis, an actual process that we put our clients through to help us identify what are their needs, how can we serve them, what is the right type of insurance they need, and how can we minimize the cost at the same time that we maximize the benefits. As part of that life insurance analysis, we gotta figure out what is that human value index? What is the financial value of your economic output, right? Not the value of your life. Like I said earlier, life is invaluable, but the value of your economic output that you are projected to put out there. The IRS knows that you will be generating wealth over your life. And because they know that, we get benefits on the tax code if we protect that value. For example, that death benefit of the life insurance policy, if it is structured correctly, will be income tax free. There's no income tax to pay by your beneficiaries on those benefits they receive. In other words, the IRS understands that the family is getting a refund of the amount of money and wealth that you were unable to generate because you passed away, too young, right? Or the person died too soon. So anyway, so we gotta figure out what is that number. Let me give you a quick napkin way, so to speak, to do this. We have more elaborated tools to do this, obviously, but I like to use the acronym that called DIME. So you can do this on your own numbers, on your own life, and that will give you a sense of how much you need. So DIME stands for debt, income, mortgage, and education. That's what DIME stands for. Okay. So once again, you can use it as a heuristic to figure out how much you need, or at least be in the ballpark. If you want a more precise number because you want to add inflation, you want to add interest rates and other potential scenarios, then again, talk to us, talk to a professional. We're happy to run this calculation for you and give you a sense of what you need. So debt is debt, right? Your car loans, your credit card debt, that personal loan to a family member, and you're gonna add all those up, and that's gonna give you a number, right? So let's say, for example, just for this example, that you have a $30,000 car loan and a $70,000 personal loan. Let's just say, so you have a total of $100,000 in debt, unsecured debt. I'll come back to income. Mortgage, very simple. How much is the mortgage, right? So let's say that right now the mortgage for this potential client that we're talking about is 450,000. Let's just say. Education is college education for the children. So let's say in my example that this person has two children, has two kids, right? And at this point in time, education is so expensive that I give a value of 100,000 per children. That includes room and board, books, everything. Obviously, if they're going to a private institution that is more expensive, then you should add that number in there. You guys know your numbers. So we need about 200,000 to finance education. So in other words, if the client dies today, we want to pay off that debt, we want to create that educational fund, and we want that mortgage to be paid off. Okay. The last component is income. So let's say this client is 45 years of age. And let's say this client is planning to work to the age of 65. So we have 20 more years of working lifetime. For simplicity's sake, let's say the client is making $100,000 a year of income. So if we take 100,000 times 20, That will mean that if the client dies today, there are $2 million of wealth that will not be earned, that will not be generated by the client because the client died too soon. So we always run with the assumption that the client dies today, actually, right? So what we do is we add them all up. 2.1, 2.550. So in total, we need 2.75, right? Million. So that will be the amount of insurance. Again, I'm just being very rough, sketching it, that the client needs. And I can tell you, based on my 16 years of experience working with clients, almost nobody has anything close to that. Part of the reason is because they never talked to a professional. Part of the reason is because they've been told they only need 100,000 or 200,000, or they think they have enough at work. The 150K they're gonna get from work is enough. And as you can see, it's nowhere in the same universe as enough. Now, these 0.7, 2.8 million are not all temporary. It's not required be a whole life. Most of it is temporary, right? So therefore, you can get a lot of this via term insurance, and it's going to be very inexpensive. If this client is 45 years of age, just as an estimation, you can get all of these for about 100 to $150 a month, less than 1% of the annual gross income of this individual. And that's another rule of thumb that we like to talk in the insurance industry. We don't want you to pay in premiums more than 5% of your gross income, because that means that you're either overinsured, which is not good, or you're overpaying unnecessarily. So once again, if you guys have currently life insurance that you own and you're not sure if that matches your financial needs or if you're overpaying or underpaying, talk to us, talk to a financial professional. We can help you figure it out so you know exactly where you stand. Okay, so that's how we calculate life insurance needs. It's called the life insurance needs analysis. Very, very important that at least once every couple of years, you guys go to this exercise so you can adjust your coverage. Again, I have lots of clients that, they bought life insurance 10 years ago, and in the meantime, they bought a rental property. They bought, additional vehicles. They have other investments. They set up a new business, and their coverage doesn't match their new reality. So that's why it's important that we review this every year or every 2 years to make sure that your cover matches your needs. That is very, very important. And nothing worse than, having the emergency of the client passing away and not having the protection that he needs. Before we go into the last topic, the last thing I will say about this is, in my career, I already delivered at least 12 death claims in my career so far. And when I meet with a family and I bring that check, nobody has ever told me, Janko, I wish my husband, my dad, my friend bought less insurance from you. That's never happened. The opposite is true. They always say, I wish you would have bought more, right? Obviously, nobody knows when somebody's going to die. I don't want to be morbid about it. It's a professional conversation. Nobody knows what's going to happen. But what I tell people is buy what you need. So that way you don't have the feeling that you bought too much or you bought too little, right? Just have what you need, carry it with you, and then that's the best we can do. Okay. I see no questions yet in the chat. Okay, not a problem. So now let's talk about some of those myths uh, uh, that people have about life insurance. As some of you on the call may know, we're highly aligned with One America. It's an insurance company based out of Indiana. Over 145 years in business. Very, very well respected mutual life insurance company. So I'm using their material today to have a conversation with you about this topic. So we already covered what life insurance is all about. So let's talk about the 10 most common misconceptions or myths about life insurance. Okay. The first one is, isn't life insurance only for after I am gone? The answer is no. There's a lot of benefits, we call them living benefits, that you can add and enjoy as part of your life insurance coverage. Sickness, disability, access to savings and cash value, tax benefits, estate planning benefits. It's a long list of tax deferral benefits. There is a lot of benefits that come with owning life insurance in its different forms. So no, life insurance is not only for when you're done, when you're dead. Like I said, it can be, to give an example of terminal illness, if a client has terminal illness and less than a year to live, they can access a large portion of that benefit while alive, to pay for medical care, to pay for, assisted care, anything like that. You can also add long-term care to your life insurance contract for that obvious purpose that if you get sick and you cannot, take care of yourself, you cannot do 2 out of the 6 activities of daily living, then the life insurance policy will kick in and provide you with the benefit. So the answer is no. Uh, Life insurance is not just for the death benefit. Think of it like a car, right? There are different trims, there are different levels of that car. If you want a AC, if you want leather seats, you want this, you want that. You can add all these perks to your contract. We call them riders to make the policy fit your situation. So now there's a ton of living benefits, and we're happy to tell you more about those if you set up a time with us to discuss it. Can I actually afford it? That's a great question. And there's been a lot of research about this. And like I mentioned earlier, most people think the life insurance is expensive. They don't realize the power of actuarial science, the power of pooling risk, the law of large numbers. So life insurance is actually very inexpensive. And it's been going down actually in cost for the last 20 years or so. Why? Because people are living longer. Now, if you guys watch the news, you probably are aware that there is a subsection of the country that actually the life expectancy is going down. That is true. But when you look at the big picture from the insurance industry perspective, the kind of person that buys life insurance is actually living longer. So therefore, life insurance costs are going down. So I don't want to sound like a salesperson necessarily, but the best time to buy life insurance is now. It's never been any cheaper than it is today. Let's go to number 3. Should I buy term and invest the difference? This is a whole debate, and I don't want to get into whether it makes sense or not. Okay? But this is what I can tell you. In 16 years that I've been doing this, I haven't met anybody that actually did this. Why? Because if you buy term and invest the difference, that means the client has to take action. They have to actually save and invest the difference. And almost nobody ever does. So when we do our financial planning, we want your savings, your insurance, and your investing to be as automated as possible. Why? Because the less that we have to make a decision about it, the more likely it is to happen. Let me give you a quick example of this. The Department of Labor did a test a couple of years ago about automatic enrollment in regards to retirement plans like 401k plans. And they divided 2 groups. One group started the job and they got automatic enrollment within 30 days. The second group had to fill out a form, submit it to HR after 30 days to get started in the 401k plan. Those were the 2 groups. One was going to be automatic. The second one, they had to actually take an action to be able to fund the retirement plan. I think you know where this is going. The first group, everybody was putting money in the retirement plan. The second group, only about 10% actually submitted the form to get started with the plan. So what am I trying to tell you? That if you have to make a conscious decision about your savings, retirement, and insurance every single day, you are very likely to make mistakes and not actually make those decisions. If you work with a professional and we can automate and out of mind, out of sight that process, you are more likely to actually be successful. So that's the fundamental reason why buying term and invest the difference doesn't work. Even if we can make a case that markets will do better than the bond market, which is a very flimsy argument, by the way, but let's go with that. Even if that was true, it still doesn't happen because it requires the client to take action and they just don't. So that's why when we set up these plans, we want to automate as much as we can so the clients don't have to make a decision on this every single day. It can be really overwhelming because this is not the only thing they have in their lives, right? We have other things to worry about. Okay, let's go to number 4. Don't I just need enough life insurance to cover my daily expenses? And I think based on the dime example that I just showed you, the answer is no. The biggest thing you want to do is to replace your income. That is the biggest thing. So if you take your income times 6 months, I think you can do a mental exercise for those of you that are here listening to me right now and say, okay, if I was to die today, can my family continue the same lifestyle with only 6 months of coverage? And I think the obvious answer is no, right? So submit yourself to a life needs analysis, have somebody do it for you so you know you have the right amount, no more and no less. Is it true that I should purchase life insurance equal to twice my annual income? No, we already talked about that. You want to draw your income at least until your retirement age. If you retire at age 70, then take that multiplier. If you're going to retire at age 65, then multiply by that amount. But 2 years of income is just not going to be, it's not going to be enough. Number six, I have group life insurance at work. Is this all the life protection that I need? It's a very common thing that I get from clients say, Janko, that's okay. Don't worry about life insurance. I have a policy at work. My company pays for it. It's all good. Well, it's not all good because most insurance policies through work do not offer more than $150,000 of benefit. The reason for this is because there's tax issues involved if they offer more than that. And like I said earlier, for that 45-year-old client that we did the example earlier, this guy right here, 150K is not even close to what they need, right? But the real issue is that in these, oops, where my thing go? Hold on. Where did it go? There we go. Oh, I guess not. Okay, that's weird. It completely disappeared. 1 second. Oh, I guess I may have erased it without realizing. Let me bring the file over again. My apologies. 1 second. We'll do this again. There we go. Um, So again, it's through work. And in this economy that we have today, where people change jobs all the time, obviously keeping that insurance through work is not sustainable. We're not in a world anymore where people go to one job and they stay there for 50 years, they get a gold watch and they retire. That world doesn't exist anymore for most of us. So you want protection that you can carry with you, right? And that's why the group benefit at work is never going to be enough sufficient to your needs. Can people in poor health qualify for life insurance? That's a very individual question, and we help our clients navigate their medical situation when they have one. Uh, and I can tell you, most people will qualify. The client will have to be uh, in significant bad health to not be able to get traditionally underwritten. But even that client that is not super healthy, there are still options out there. There is a reinsurance market, there is a guaranteed issue market. The life insurance world is very, very broad. So if you were declined before, if you know you have some medical issues, let us know. We're happy to go out in the marketplace and shop for you and find the best fit for your needs. Some companies focus on diabetes, for example. Some other companies do very well with cardiovascular issues. Many of you may find this surprising. When I got in the business, if the client had HIV, that was an automatic decline, right? It used to be a death sentence, it's not a death sentence anymore. Now there are companies that if you have HIV that is undetectable and is under control and you're taking your medications, we can actually provide life insurance at a standard rate. Kind of crazy, right? So there's also evolution in our industry. So don't give up. If you were declined before or you're concerned about your medical issues, talk to us. We're happy to shop around and see if we can find you any reasonable options. Okay, two more, I think, and we're done. We're almost done. I'm young. Why will I need life insurance now? Well, the answer is obvious because you're young. That means you're young, you're healthy, and our largest liabilities is when we're young. That's when we have young children. That's when we have long-term mortgages. That's when we have all these financial responsibilities when we are young. And by young, I mean 20s, 30s, and 40s, right? That's maybe even early 50s. That's when we have the highest responsibilities. So I tell my clients, if you can afford to buy it now because it will never be cheaper for you than it is today. Because we'll never be as young as we are today. So the sooner you can better lock it in and you can carry it with you for the rest of your life. And one last thing, sometimes clients tell me, well, I don't know if I want to get married. I don't know if I want to have children. Doesn't matter. Just get it. Because if you never have them and you decide that you don't want to have kids, then you can just surrender the coverage. And if you buy whole life under this cash value, you're gonna get your money back plus some. So there's no harm in actually getting it when you're young and healthy. It's as cheap as it's gonna be for the rest of your life. And again, especially if you buy whole life, you're locking in that low cost for the rest of your life. That's very, very, very important. Number nine, my spouse is the sole breadwinner and I stay home with the children. Why would I need life insurance? Another very, very common question that we get. And my response to that when I hear that question is, I ask the client, let me ask a question. And this is a gender neutral conversation because it could be a stay-home dad, it could be a stay-home mom. It doesn't matter, right? So when you have a stay-home parent, I ask them, okay, if you were to die today, how much will it cost for your spouse to go out and get a nanny, cleaner, washer person to come in and take care of the kids for 12 hours a day, clean, wash, do everything you need to do every day for the next 20 years until they're able to take care of themselves? How much will that cost? And we make a very simple calculation. In California right now, minimum wage is 20 bucks an hour. So let's say you're gonna pay in 20 bucks an hour to somebody to come in and do all that work, 8 hours a day, 7 days a week, times 20 years, right? You can make that calculation on your math. It's millions of dollars. That's the point. It will cost the other spouse hundreds of thousands, if not millions of dollars, to provide that benefit to the kids that you won't be able to provide because you died too soon. So the point is, even for stay-home parents that don't have any regular job, they're still providing a tremendous economic value to the household, tremendous value, and that value should be protected. So both husband and wife should have life insurance. All right, number 10. We are age 65, empty nesters, and retired. Our home is paid off. Do we really need life insurance? It depends, right? It depends. There are tremendous amount of tax benefits that you can get access to via life insurance that you cannot access in any other way. And as you can see here, as part of your Social Security strategy, as part of your pension maximization strategy, uh, is so, so important. Let me give you one example of this. Uh, Going back to my earlier conversation about a non-working spouse, right? A lot of people believe that when the husband or the wife dies, then you're going to continue to receive their Social Security. And the answer is no. You receive a beneficiary benefit, but you don't get the same amount. In other words, the income will go down. And how much will go down? Well, it depends on a lot of factors. But the point is that you may need to replace the Social Security income, that pension income, when the spouse dies. And the most efficient way to do this is through the use of life insurance. So actually, life insurance can be used to provide retirees with a higher tax-free income than otherwise will be the case. You can do that, right? And it goes back to the tax-free benefit when the person dies. Also, it can help your state to pay for mortgages, to pay for bank loans that may be outstanding on your state. There might be all the things that you are leveraging on your state to get tax benefits that will come and haunt the next generation, right? But if you have the right amount of life insurance, then it's a wash. The other thing that I can think of that is very relevant to today's world is reverse mortgages. You guys may know that about 65% of Americans own their own home. And for middle income people, we define middle income as households making less than $400,000 a year, right? So for middle income households, the grand majority of their wealth is in their homes. So home ownership has become, and again, you can argue whether this is right or wrong, but it is what it is, has become the key to financial success for a lot of middle income families. The question is, how do you unlock that wealth? So a lot of people are resorting to either selling their assets, selling the home, or accessing the value through reverse mortgages. And I'm not going to talk about the value of reverse mortgage today. That's a topic for a different day. But if you do have a reverse mortgage, you're going to carry a loan. And that loan is to be paid off when you die. So if the goal of the client is to pass on their home to their kids, they won't be able to, or they will have to not leverage on it and therefore have a lower value retirement in order to not carry that debt and be able to pass on those assets to their kids. Life insurance solves that problem because then you can unlock that wealth, use those loans, and then when you die, they will be paid off by the life insurance, right? So again, I'm not saying you should or you should not do one thing or another. All I'm trying to tell you is that life insurance as a tool can unlock other areas of wealth that right now you may not be thinking about. And in doing so, give you better retirement, give you more flexibility, give you more income to spend with your loved ones. So very, very versatile product and tool that you can use in your life. All right. So it's 6:15 here in the West Coast. I'm pretty much done right on time, 45 minutes. Are there any questions in regards to what we talked about today, life insurance, or any concerns or any comments that we should address before we complete today's webinar? Let me see here. Nope, I don't see any questions. Well, if you guys receive this invite, you're gonna receive a survey afterwards. So I will really appreciate if you guys could complete that survey. And if you have any questions that you'd rather deal with in private, feel free to email me back. My email will be on the Zoom link, and you can email myself or my team. You can go to qx-financial.com. You can also find information there, and we're happy to. Oh, there is a question. Oh, thank you. I appreciate it. Thank you for the comment. Great webinar. Appreciate it. If there's any other questions that you may have, feel free to reach out to me and my team. We're happy to support you and help you in any way we can. In the meantime, enjoy your evening, and we'll see you on the next one. Have a wonderful day.